Before we start worrying about debits and credits into the ledger, we need to basically reinforce the notion of the accounting equation. So on the left side of the accounting equation, we've got the assets, the economic resources of the business, our stock, our equipment. If we've got surplus cash in the bank, that'll be listed, amounts owing from debtors, etc. On the right side of the accounting equation, we've got the equities, the claims on those economic resources. And we can split those equities into two types. We've got our internal claims on those economic resources. That's our owner's equity, our capital. The external claims on those economic resources, well, they're our liabilities, so amounts owing to creditors, amounts owing on loans, mortgages, etc. Which gives us the accounting equation. On the left, we've got the items of value, those economic resources, our assets, and on the right, we've got the claims on those assets, internal being owner's equity, external being liabilities. It's a key aspect of double entry recording that you need to have your head around. So looking at the fundamentals, when in doubt, always come back to the balance sheet. On the debit side, the left side of the balance sheet, we list and value, because of the monetary principle, we list our assets. On the right side, our credit side, we list our liabilities and owner's equity. So when you're not sure whether to debit or credit, ask yourself this: is it affecting an asset, a liability, or an owner's equity? If it's affecting expenses or revenue, then it will affect profit, which will affect owner's equity. Always come back to the balance sheet. Second point about ledger recording is that every transaction has an equal debit and credit dollar effect on at least two ledger accounts. If there's GST involved, there's going to be an odd number of accounts. If we're doing sales, cash or credit, then it's going to affect 5 accounts with the GST component. But debits always equal credits for every single transaction. Otherwise, you won't balance in your trial balance and thus your balance sheet. So what do we mean by a ledger? Well, it's an account used in a double entry system that records the debit or credit effect of transactions that affect the relevant account. So we don't use ledgers in a single entry system. We just use journals, and then we go from the journals to the reports, the income statement, balance sheet, cash flow. In a double entry system, we use ledgers, then we total them up, balance them off, close them off if they're revenue and expenses, do a trial balance, and then we do our outputs, our reports. The general ledger refers to all our ledger accounts as opposed to subsidiary ledgers, which we have for individual debtors or creditors. That's not part of the general ledger. We record them separately to help keep tabs on who we owe and how much we owe, and who owes us and how much we owe. So, again, let me emphasize this to death if need be. A, assets must always equal L plus OE. The accounting equation balances before we actually start our reporting period. It'll balance at the end. It'll balance after every single transaction. Double entry rules. And again, link this back to the balance sheet. If we increase an asset, assets going up, so we've bought more stock, then we debit the stock account. If an asset goes down, and your classic asset going down is when you pay money out of your bank account, that's going to result in a credit to that asset. Liabilities and owner's equity, they're on the opposite side of the balance sheet, so we do the exact opposite. If we borrow more money, our loan balance is going to go up, so we're going to credit our loan account. If we pay off a mortgage or part of a mortgage, then we're going to decrease that liability account. When the owner kicks in some capital, that's going to increase our owner's equity, so we're going to credit that capital account. And when the owner withdraws assets out of the business, that's drawings, that's going to decrease our OE, so we'll do a debit. Again, always link it back to the balance sheet. You should have a visual representation in your mind that on the debit side we list our assets, and on the credit side our liabilities and owner's equity. Once you've got that in your head, that's going to make it a lot easier to remember these rules. So a ledger account has 3 ingredients. We've got our date, which will usually be at the end of a reporting period, at the end of the month, quarter, maybe the half year or end of year, depending on the volume of transactions. You'll be told that in the question when the posting date is. The cross-reference, we need that to identify the other ledger affected by a transaction. This is going to support the audit trail should we have any bookkeeping errors when we're actually posting from the journal to the ledger. And of course, we must have, to comply with the monetary unit principle, the amount in Aussie dollars. For opening balances, we must list them for assets, liabilities, and owner's equity. We don't have opening balances for revenue and expenses. We close them off at the end of each reporting period to comply with that principle, and also to comply with the relevance QC, that we can get an accurate measure of profit for each individual reporting period. And in order to do that, we've got to zero off, close off our revenue and expenses so that we can start the new period afresh. Again, always link it back to the balance sheet. I'm just going to go through a quick example of posting to the general ledger from a completed payments journal at the end of a reporting period, December in this case. Note we've got our sundry items down the bottom here. We're going to have to post them as well. So the bank balance. This is our total payments for the month of December. So the impact on the asset bank of paying out money, $72.90, is it's going to decrease our bank balance, obviously. So again, thinking back to the rules of double entry, we do a credit entry when an asset goes down. Our cross-reference is cash payments, because that actual $72.90 is made up of a number of separate payments. So for simplicity's sake, we just do one entry rather than the 6 or 7 different accounts affected. One entry will suffice. Discount revenue is an interesting one. The actual value of the amount of reduction that we actually have to pay to the creditors for paying promptly means that we've actually reduced a liability and at the same time increased owner's equity. So we've actually satisfied the definition of revenue there. So when revenue goes up, it increases owner's equity via the profit. So we do a credit entry, and the other account affected is of course the creditor's control, because it reduces what we owe them. So this $1,100 here is made up of the $90 that we don't have to pay because we've paid promptly, and $1,010 that we have actually paid to the creditors. So therefore we do a slash entry. Bank, $1,010 plus the $90 discount revenue means we're settling $1,100 worth of debt. It's important that we get that $90 in there, because otherwise it'll appear as if we still owe that money. Okay, stock control, we've bought stock. Stock going up, that's an asset, so we do a debit entry. Cross-reference bank, because that's how we funded it. Prepaid rent, we've created a future economic benefit for ourselves in the form of occupancy of space. So therefore, asset going up, $500, debit entry. Bank is your cross-reference. Expenses going up, wages. Expenses increasing will decrease your profit and decrease your owner's equity, so that is a debit entry. Drawings, like I said before, owner's equity is going down. The owner is taking assets out of the business, so that's actually going to reduce the owner's claims on the assets. So we do a debit entry with a cross-reference to the bank. Office equipment, again, asset going up. When we increase an asset, go back to your rules of double entry. That's a debit entry, and we've paid for that, as opposed to a sundry creditor. GST payments reduces or offsets the GST we collect. So therefore, that is a debit entry because we've reduced the amount that we owe to the ATO. It offsets the GST we collect from our sales. And that'll do for now. Hope this has been of use.